Hello everybody. So today I want to talk about three stocks that could win big in the light of incoming rate cuts soon. Maybe the market participants are getting pretty excited about that. Of course, yesterday was the Fed meeting, the Fed letter, and the press conference. Almost an hour of journalists pressing questions, trying to get a nugget that will move the market to the downside. Thank goodness these journalists did not succeed. We've had good news. We had a dovish Fed yesterday. The good news is apparently 2 rate cuts are coming. The market supposedly was scared only 1 rate cut was coming. I still think it's going to be more than 2 rate cuts. I'm very optimistic about that because they don't have a choice. And instead of talking about the Fed madness and the rate cuts and the macro, and instead of me giving you my opinion on unelected geriatric committees that are always 3 years too late, let me give you my opinion about stocks. And of course, I'm not talking about the Fed, of course, geriatric committee. I'm not talking about the Fed. I want to give you a preface about the stocks I'm going to talk about. All stocks will benefit from the drops in rates. All stocks will benefit, but the stocks I'm talking about are tied to consumer demand. This is consumer demand going up as a result of rates going down, right? So that's not going to be a stock like HIMS. That's not going to be a stock like Health that sells cheap makeup. It's going to be a stock that sells a product that usually needs a loan. So that's the point number one. But know that all stocks will benefit somewhat because interest rates are like gravity. When they are high, the economy is down, layoffs are up, asset prices are down, whether it's homes, whether it's real estate stocks, they're all down because interest rates are like gravity. They act like gravity, and they are decided by an unelected committee, right? And so, of course, in my view, the rates need to be cut 3 years ago. They need to be cut 3 years ago. The U.S. government, U.S. states, cities, households, and there's an astonishing amount of zombie companies, right? As I've commented in the past few months about Walgreens when I cover HIMS, there's a whole amount of zombie companies that also need rate cuts, not just the U.S. government or the U.S. states. Imagine taking over the U.S. government right now. It's a disaster. The rates are short-term. There's trillions that need to be refinanced ASAP because they didn't issue long-term debt. Anyways, this is not a macro video. The point is the rates need to be cut 3 years ago. That's not going to happen. And so, as always, this is something that I think will happen precipitously. In an emergency, right? That's why two rates to me, two rate cuts is a bluff. In my view, this has not changed. Nothing has changed for the past 5+ years. It's QE to infinity. There is no alternative. Tina, very nice name. And then, as I call it, and I've called many of my videos like that, calling the fiat bluff. That's what Saylor is doing with MicroStrategy, calling the fiat bluff, saying, oh, lend me money at 10%. Sure, I believe you're going to repay the money. No, everybody knows that the money is not repaid. You just create more debt in the system. It's just a mountain of debt. Anyways, let's go and talk about the free stocks where consumer demand will help and will trigger sales. The first stock, of course, I want to discuss is Enphase. So, Enphase, I sold Enphase last year for tax loss harvesting reasons. Enphase just happened to be my worst performer in my portfolio. I sold it a little higher than $70. So, right now it's an opportunity to buy it back actually lower. It's trading in the low 60s. But the point is, I'm sad I sold Enphase. I'm still a bull on Enphase. I'm still bullish, but I at this point, I was looking for something to sell. So I sold Enphase. I want to get back into Enphase. Rest assured of that. And studying that company today, it looks like, the revenue is turning around if you look on a quarter-by-quarter basis. But if you look at the analyst number, so of course, December 2024, year ended, we had 1.33 billion. Now, the analysts are telling us that December 2025, we're going to have 1.55 billion. December 2026, we're going to have 1.83 billion. This is the beauty of being in a secular space. Solar is a secular revolution, in my view, there will be no such thing as a roof without solar, maybe by 2035. Most roofs will have solar because it just makes so much sense. It's wasted energy. Most roofs have enough space to power themselves just with solar and with solar alone. And with the advent of batteries, this is even more of a no-brainer. So you can see there's 34 analysts, and the analysts have been, very tough in Enphase. If you ask me from listening to the calls, I used to cover the calls pretty closely whenever there was a call. They've been very tough in Enphase. These tough, bearish analysts are telling me 1.55 billion. I'm loving this. I'm loving this number. That would be a plus 17% revenue growth. And what that means is that I can input the numbers into my spreadsheet here. Note that the EBITDA margin compared to the last time I had covered went way up at 22%. So they're collecting those IRA benefits quite a bit. Those IRA benefits are kicking in. They're moving the production to the United States, right? They closed recently a whole facility in Eastern Europe. They closed there. They're moving all of the manufacturing to the US because, at that point, these microinverters are mostly paid for by the subsidies, because the subsidies have been misdesigned, as they always are, by political forces, political opportunities, what I tend to call this. You take advantage of a government not knowing what it's doing and just misplacing the opportunity. So that's why they make a lot of money now. This is a company that makes a lot of money now. And, of course, it's the premium pure play solar company. In my spreadsheet, I show it on the Patreon. It's the premium pure play solar company. If you want a premium pure play solar, if you want a story of a high quality company with strong long-term returns, and actually, if you look at, despite the precipitous drop, despite the destruction that interest rates did to Enphase, killing the real estate market. Who's gonna borrow $30,000 to put money on the roof when they just came, underwater on their home because the real estate market has entirely stalled as a result of the interest rates? This company was right in the crosshairs of the interest rate hikes and quote-unquote attack. Despite that, it still beats the QQQ, not by much, I'll give you that, but over a 13-year period, it still beats the QQQ at 17.92% versus 17.3% on the QQQ. Now, of course, that was a major roller coaster. Holding the stock has been a roller coaster, but that's the nature of volatile stock. Volatility is the price you pay for higher return, and I find this stock cheap right now. The point I was saying is this is the highest quality stock in the space. They're a global company. They're going to India. They're going to Brazil. They're getting stronger and stronger in Europe. California is now a good market for them. The US is decent for them. They have the Enphase system. They're building a whole ecosystem of new things, and that's why I say winter is for building. Right now they're definitely not getting any credit from the market. So what are they doing? They're building on innovations, right? They released the balcony solar. Balcony solar, very popular in Europe. Plug-and-play solar is another thing they call it. And you walk in home improvement stores in Europe, you have a bunch of balcony solar solutions that are just sold, which are microinverters, and you just put solar, on the balcony or on the patio. You just put a few solar panels and reduce your electric bill by sometimes $50-$70 a month just by plugging it in any outlet. That's something they're getting, and I think that's very wise for Europe. They're going to compete against a lot of the Chinese solutions. They have their own branded solution for these portable batteries, which has taken the world by storm. This is, of course, disrupting generators. Home generators are being disrupted by these little machines, and they're going heavy in the development of their car chargers, the Enphase charging solution, the one-way and the two-way charging solution. And so I think, and of course the battery, right? The Enphase battery right there is going to be a big market. This is the premium pure play solar. And one thing I want to say really quick about Enphase is, of course, when I sold the stock, I stopped covering Enphase as closely, but there was something, and it's still something being discussed. It was the whole story of the Powerwall. I remember, people were telling me, the Powerwall is going to kill Enphase. The Powerwall, the Tesla Powerwall, is going to take over. I think people, because I'll talk about Tesla really quickly at the end of the video. I think people who dislike Tesla need to be consistent with themselves. If you think that Tesla products are not going to be sold because of, say, Elon Musk's reputation or whatever. If you think Tesla products are not going to be sold, then the Tesla Powerwall should not be a threat to Enphase because it's not going to be sold, because most of these Powerwalls, they're placed outside, on the side of a garage, visible from the street. They're very often placed outside. You don't want to have a Powerwall. You don't want to support Tesla, and the boycott, goes both ways. And so one may believe, okay, well, that's not much of a threat. Nobody's going to buy the Powerwall because of Elon Musk, right? To tell you kind of the silliness of this argument, you don't want to get your Powerwall vandalized, right? And so of course I don't believe that. Of course I believe that the Powerwall is a risk to Enphase. I am very mindful of that. But the more I think about the Powerwall 3, it's more of a marketing innovation than an engineering solution. It's a marketing innovation because people are going to have that sunk cost fallacy of saying, well, I want a Powerwall. It already comes with a string inverter. Why would I just get microinverters on top of my string inverter? Tesla already put a string inverter there. I paid for it already. I might as well use the string inverter. But from a technical perspective, the issue of the string inverters, which is the fact that you still have to put a switch off at the panel level. For safety reasons, you need to be able to shut off the panels in case of fire, in case of emergency. You still have double the installation, right? It still costs twice as much. You still have to put a little box under the panel. So why just not go ahead and just put a microinverter that has a switch off built in and then connect to a Powerwall? And so I think that's the solution that a lot of people are going to choose. You could also have some hybrid solutions, but to me, this is a strong, how could I say a strong? This is a wicked business move. This is a really, really good business move to throw it in for free so that people don't go buy the Enphase solution. But that's a business innovation. That's a marketing innovation. That's not a technical innovation in my view. Technically, I much prefer the micro inverters, and I've covered that multiple times in multiple videos, right? The triple penalty when you convert from AC to DC to DC to AC to AC to DC, that triple penalty is minimal because microinverters are getting more and more efficient. They're so efficient today. The next gen of them with gallium nitride is going to be even more efficient. The redundancy is a big selling point for Enphase, and the redundancy is also a no-brainer for Enphase because they're going after that political opportunity. So they put six microinverters in the car charger. They put 6 microinverters on the wall at the battery level, and then they're gonna put 12, 18 microinverters on the roof. Enphase is an inverter selling machine. It is a subsidy getting machine, and that's kind of a big reason as to why I think Enphase is still more than a viable play. I'm very happy to try to get back into Enphase. I'm hoping for some leaps. If the stock drops, if we get some fears about the IRA, that's when I would like to get back in Enphase via 2027 or hopefully by then 2028 leaps, because when I look at the pure play solars, this is it. And of course this stock Enphase has been hurt. It has been hurt by the interest rates. Who is buying a solar installation when the rates are so high? These installations are often financed at rates that are close to consumer rates, right? To consumer borrowing rates. Moving on to Inmode. I haven't talked about Inmode in a very long time on this channel. And so, of course, I invest it all. I look at all stocks and I invest in them all. And Inmode is a stock that crossed my radar. Note that Inmode is actually beating Triple Q by about 1%. It's 1% more than Triple Q, despite the precipitous drop in 2022. You can pinpoint when the rates started to drop. You can pinpoint the quote-unquote end of Inmode's stock price. All of a sudden, the market got scared. But if you look at Inmode 2, okay, 2025, the revenue is looking flattish from 394 to 393 million. But if you look at the analysts in 2026, they're much more positive, predicting 433 million. So this is a stock that's going to grow a nice 10% the year after this year. So the growth will come back. And in my view, the growth will come back, of course, because of the nature of the product. The nature of a product is an expensive machine. It's an expensive product. The product looks like this. It's these machines. They cost between 80 and 150 grand, depending on which one you look at. And of course, it's typically the beauty offices or the surgeon's office who has to buy multiple ones of this machine if they want to have a complete solution, right? If they want to offer everything Inmode has to offer, and it's in the cosmetic beauty field, you probably need to have about $1 million worth of different machines in order to do this. But the chief way that Inmode makes money, and that's going to be the long-term story for Inmode. I still own all of my Inmode, by the way. The way they're going to make money is these attachments. You see these, they call them handpieces. All of these attachments, they're what? Between 100 and 150 bucks each, all of these attachments. And they need to be changed when you go through a fat melting is not the best way I can describe this tech. When you go to a fat melting treatment, oftentimes you have to go through like 8 treatments, something like that. And the micro needles that they use to melt the fat, and they have their own patent and everything, the micro needles that they use, they're single use. They need to be replaced. And so that's a huge margin. That's an 80% gross margin. This is the coffee and pod business, if that makes sense. That's why this business is very profitable. Profitable is 80% gross margin. EBITDA margin is 29%. So this is getting really high. The valuation is 1.8 times sales, also a very low valuation, and it's trading at 5x forward EBITDA. Otherwise said, it's super cheap. Growth, in my view, for Inmode will likely come back when those rates drop, because the surgeon and the beauty offices that do these procedures that are very popular in major cities like the Los Angeles of the world, all of those, they're going to be able to spend 80 grand on new machines. The sale of these machines is heavily impacted by the rates, because the rates are the consumer credit rates, which means that right now, to buy an $80,000 entry-level Inmode fat melting machine is going to be $80,000 at 12-13%, something like that. So a lot of surgeons are like, hold off on this. We're going to wait until the rates drop. But over the long term, once these offices are equipped with these machines, this is just a cash printing machine. It's all about the supplies. It's all about selling the supplies. Very similar to Intuitive Surgical. If you follow Intuitive Surgical, ISRG, they make a lot of money by selling the tips, by selling the heads. This is the same thing for this company. And of course, these procedures in the world of Instagram are getting more and more popular. And these procedures are also getting more and more popular in the world of GLP-1, because he explains that oftentimes GLP-1 is successful at making you lose weight, but your skin still looks the same. And so actually, the CEO explains we see an uptick in demand for these procedures after someone's been on GLP-1, because all of a sudden, you don't have a tight skin. And a lot of these procedures, you can see the name of products like, Body Tight. I think they had one Skin Tight, Contour. Anyways, this is pretty much the story of this company. I like it very much. Still got some time to add to this one. I don't think it's going anywhere in the short run, like in within 1 year. I don't think it's going much anywhere, but I think the growth will come back at some point. And so, I'm happy with this. This company's a tiny position. It's just play at this point for me, this company. Moving on to a stock that is not tiny position. That is a big position for me. My second biggest after MSTR. And Bitcoin derivatives. That's Tesla. Tesla is my most hated stock. That's why I know a lot of my followers hate Tesla, so I'm not going to talk about Tesla a lot. I know everybody disagrees with me on Tesla. Will lower interest rates help Teslas? Definitely, absolutely, definitely. Tesla cars are still expensive, and cars are mostly financed. This is what Elon Musk has said. People think of buying cars in monthly payments. It's all about the monthly payment. If the monthly payments drop, it's likely that Tesla will do something about its pricing, maybe increase the pricing, maybe keep the pricing down to increase the volume. But, in a nutshell, this is a caricature, of course, but in a nutshell, at current interest rates, if you borrow money for a car, what are you going to pay? 9%, 8%, outside of a promo, of course, but you're going to pay 8 or 9%. That gets you a Dodge Neon. If you get near zero interest rates again, which, I firmly believe will happen because of TINA because of calling the Fed Bluff. If we get interest rates near zero at the Fed level, what is that on a car loan? Is that 3.99 on a car loan? Then all of a sudden, the delta between very high interest rates and the low interest rates is a Model 3, right? You may get a Model 3 instead of a Dodge Neon. Now, of course, I'm playing here because Dodge Neons don't exist anymore, and I don't think they were ever that expensive. But you get the point of what I'm saying here. And of course, you're like, okay, well, what am I talking about interest rates? And I would say you're right. I would say, the valuation of Tesla currently has nothing to do with cars, and so I think the interest rates will mostly matter in the view of the Wall Street narrative, because the Wall Street narrative, Wall Street still views Tesla through the lens of cars, and so you're still going to have a part of Wall Street that's going to trade Tesla stock based on their car sales. But this is akin to, in the early days, okay, e-commerce now for Amazon matters more and more, but if you look at in the Amazon throughout, say, all of the 2010, but AWS is Let's go around to 2010. Throughout the 2010, Amazon never traded on e-commerce. It always traded on AWS, but it took a decade for the market to notice AWS and to forget about the e-commerce part of the business. And I believe for Tesla right now, you still have a share of the community that looks at Tesla as an auto company. You have more and more people who look at it as an AI company, but the decade of the 2020s for Tesla will be an AI-driven story, in my view, not an auto sales story. So you could say this doesn't matter, but it matters slightly to Wall Street, and I do think if the rates drop, cars are going to get sold a little more. Some people may keep a poor-looking car, a bad car. They may keep it a little longer and be waiting on the rates. And this is the classic debate between Austrian economics and what's the name of this? Anyways, this is a classic debate in economics between classic economics and Keynesian economics versus Austrian economics. This is a classic debate. Do people buy a car because interest rates are low, or do people buy a car because their old car broke down and they need a car? The truth is probably somewhere in the middle, but of course, as a Bitcoiner, I'm going to go towards the side of Austrian economics and tell you. Anyways, sorry about the tangent. I'm still busy with family, so this explains kind of the tangents today. Thank you so much for watching. This was not investment advice, not financial advice. This is just entertainment. Please like, please subscribe, follow me on Patreon, follow me on X. Thank you for watching, and have a wonderful, wonderful day.